everyone, and welcome back for another Indie Wealth Monthly Market Update. As always, I'm your host, Nathan Zimmerman. Today, we'll be discussing year-to-date performance of the S&P 500, identifying which sectors of the market are doing well and which are not, and talk about the potential costs of trying to time the market. For starters, in February, the S&P 500 was down by about 1.4%. The markets had been holding up for most of the month pretty well, but stumbled late as the U.S. began its operations in Iran, which caused a bit of a sell-off. Anytime you get these geopolitical shock events, it causes some uncertainty, and uncertainty usually leads to volatility, and that's exactly what we saw. After gaining around 1% in January, the late February sell-off erased those gains and put us slightly negative year-to-date by about 0.4%. But zooming out, the market is still up by double digits over the trailing 12 months. So it's always important to zoom out and focus on longer time frames. Now, in the chart above, you can see the returns of the various sectors of the stock market year to date. Number one by a considerable margin is energy, as the unrest in the Middle East has caused oil prices to spike. The higher oil prices go, the more profitable oil companies become. So it's no surprise to see that sector leading the way here in 2026, given what's going on. Now, you see technology has been one of the laggards year to date. After being the standout sector in the market the last few years, technology has taken a bit of a back seat here in 2026 as the market tries to digest what the ongoing AI revolution will mean for tech companies going forward. Despite the muted year-to-date performance in that sector, the earnings of the tech sector are expected to grow by around 30% over the next 12 months. And over the long term, as I always say, stock prices tend to follow the earnings. But big picture, this chart is a great reminder of why it's important to be diversified across multiple sectors. It's impossible to know at any given time which sectors will be winners and which will be losers. But by staying diversified and maintaining allocations across a broad spectrum of asset classes, we can ensure that we're always participating in the areas of the market that are strongest at any given point in time. Now, as I've said many times, lots of things can move markets in the short term, geopolitical conflict, for example, as we're seeing right now. But over the long term, the primary driver of market returns is typically earnings growth. And corporate earnings growth is expected to be strong in the coming quarters due to pro-growth policies, lower tax rates, resilient consumer spending, and more. Now, you can see in this chart, the earnings growth rate for the next 12 months is estimated to be 15% for the S&P 500 overall. We can compare that with the historical average earnings growth rate of about 7.7%. So growth is expected to be well above average over the coming year, actually about double the historical average. And as mentioned earlier, the technology sector is expected to lead the way with 30% earnings growth. And just to show you how important earnings growth is to the returns of the stock market over the long term, this chart paints a clear picture. This chart shows us the S&P 500 index growth alongside its trailing 12 months earnings growth. Simply stated, over the long run, the stock market tends to follow the trajectory of earnings. If earnings are rising, investors are willing to pay more per share for stocks, which pushes the markets higher. Now, having said that, just because earnings are expected to rise by double digits again in 2026, that does not necessarily mean the market will simply glide higher over that same period of time. Lots of things can happen that negatively impact markets in the short run, as we've just seen with what's happening in Iran. And this is why corrections are so common, even in years where the economy is strong. We can see in this chart just how common pullbacks are. We typically see several large pullbacks each year with very few exceptions. It's simply part of being a long-term investor. You can see in this chart how many times the market fell 5% each year, going all the way back to 1980. On average, we experience nearly 5 unique 5% pullbacks in a given year. Even last year, the S&P 500 was up more than 15%, despite 6 pullbacks of 5% or greater. So don't let that next pullback discourage you. But despite the surprising regularity of corrections, stocks have still been a great way to protect and create wealth. The ability to stay patient is an important and valuable discipline. We have to be willing to ride out the periodic bouts of volatility to capture the long-term returns that the stock market offers. And this chart shows us why staying invested is so important. We can see here the impact of missing the best days in the market over the past 25 years. If you simply wrote out all of the volatility along the way, $1,000 invested in the year 2000 would have grown to nearly $6,000 today. But if you miss just the single best day during that 25-year period, your return drops to $5,263. If you miss the best 10 days, your return is more than cut in half down to 2,615. And if you miss the best 30 days over that 25-year period, you'd actually have a negative return. And what do we know about when the best days tend to occur? Well, they tend to closely follow the worst days. They tend to happen when a correction is coming to an end. So to ensure we're invested for the best days, we have to be willing to endure some of the worst. The cost of moving out of the market simply because we're going through a downturn can be very damaging to our long-term returns. It's not being invested when the market goes down that hurts investors. It's not being invested when the market starts to recover that does the long-term damage, as this chart shows us. The only way to ensure that we're capturing the returns the market offers is to stay invested, even during times when it feels a bit scary. That's when some of the best days tend to happen, and we cannot miss those best days. So again, when volatility arises and pullbacks happen, just remember to stay patient and stay invested. It's been a sound strategy throughout history. It's impossible to time the market. Just get invested and stay invested. And over the long term, you're likely to be pretty happy with the results. So that's going to be it for me this time around, but I do want to ask for your help in getting these videos in front of some new folks who might find them useful. If you share this video with a family member, friend, or colleague, let me know. In about a week, I'm going to throw the names of anyone who shared the video into a hat and choose one name randomly, and that person is going to have their pick of one of our IWA hats, which these are pretty nice, or one of our insulated IWA mugs. So I'm going to start doing this each month from now on. It's and easy to share these videos, especially if you just follow our Indie Wealth Advisors Facebook page. If you don't already, we'll post the video there, and if you share it, we'll throw your name in a hat, and if you're lucky enough, we'll choose you this month. So that's going to be it, though, for me. Thanks for tuning in.